the main question that keeps people away from investing in leverage ETFs is, what if we have a dot-com crash? What if we have a great financial crisis? Will these leverage ETFs survive? Most people stay away from investing in leverage ETFs because they are misinformed and because many experts out there are making a disservice to investors. Because, as I explained before, these leverage ETFs, you can have strategies that will 10x, 100x your returns over a very prolonged period, and they are indeed suitable for long-term investing if you are doing the proper strategies. But people still stay away from them because if you have a dot-com crash or if you have a great financial crisis, these ETFs will be wiped out. So what I'm going to show you in this video is that that's not true. If you do a little trick that I'm going to explain in this video, you will survive and thrive very well during a dot-com crash or during a great financial crisis, during any big crash. You'll profit very well, and now you'll have much more money than you would otherwise have for your retirement, and you will survive through those big crashes with leveraged ETFs. All right, are you ready? Let's get into it. In my community, in the Henrique Wealth Academy, we have lots of discussions about leverage ETFs, leverage ETF strategies, and there you can find also a 5-hour-long course about leverage ETFs. Check the link in the description, 7-day free trial. You can check it. If you like, you stay. If you don't like, you can leave. Okay, but now let's jump here on the screen. And what I have done, what I like to do is not only backtesting, but I also run Monte Carlo simulations, and I have been investing in leverage ETFs since like 2020 or 2021, and I survived the 2022 bear market, where there was very large drawdowns, but if you follow the right strategies, you'll still profit very well. Okay, let's jump here on the screen, and what I have done here is very simple, a very simple simulation, okay? We are looking at 40 years of data. So 40 years, it covers the dot-com crash, the 1987, going back to 1987, it covers the big 1987 crash, the dot-com crash, the great financial crisis, and all the other crashes that we had in the meantime. We had the pandemic, we had 2022. The markets are constantly crashing, but on average, they always go up, okay? Every single crash that we ever had was followed by new all-time highs and all-time highs and all-time highs. Just, by the way, fun fact, over the last 10 years, we had 310 new all-time highs, okay? And that's where the leverage ETFs thrive. Okay, but looking here at my simulation, I just want to compare what if you have invested 100% in S&P 500, SPY, the regular S&P 500. S&P 500 is great because you are betting on the 500 biggest companies in the US and in the world, right? S&P 500, you are basically, you are a business owner of a little bit of the 500 best companies in the world, okay, which are American. Most of the best companies in the world are American, or 15 out of 20 are American, right? You can name probably out of your mind very quickly 10 American companies. I cannot name 10 Portuguese companies, and I'm a Portuguese, right? So that's how it works. So S&P 500 has been the standard for most investors, most people that are into FIRE, financial independence, retire early, people that are saving for retirement. It's S&P 500 index ETFs such as SPY or VOO. I usually talk about SPY because it's more popular, but VOO, the Vanguard S&P 500 ETF, it's probably even better a little bit because the fees, the expense ratio is even lower. Okay, but going back to our simulation, we are looking at 40 years of data. In one of the simulations, we have 100% into S&P 500. The other, we have 50% into S&P 500 and 50% into the TQQQ, okay? I usually give the example of the TQQQ because it's more extreme. More extreme returns, more extreme risk, more extreme drawdowns. And you still have very good results. Of course, instead of TQQQ, you could do QLD, which is 2x leverage, or UPRO, which is 3x S&P 500, is also a little bit less volatile. But in this case, we are doing TQQQ just for the sake of the example. And then what we are doing, we are rebalancing quarterly. The rebalancing here is the secret sauce, okay? You need to rebalance your portfolio, okay? So I backtested this data, and what we have here is very interesting results. So these are 40 years of data, and you have invested initially $1,000, okay? Only $1,000. And in the case of the S&P 500, you'll have transformed $1,000 into $83,000. That's pretty good, right? It's an 8,000% return. But in the case of the SPY plus TQQQ, instead of $83,000, you have $1.3 million. Let me repeat that. $1.3 million versus $83,000. It's like 15 times more by allocating 50% into TQQQ. This is like almost like black magic, but in finance, right? It's very crazy returns. We're also talking a prolonged period, 40 years, of course. 1986, like I was a baby, a very small baby in 1986. But the cumulative return is 130,000%. Unless, also, one of the important things that I want to do here is to share with you this chart. This chart is very important. This chart is the performance of these 40 years, okay? And the performance of the 40 years, it's something very interesting because, again, you went, unfortunately, the chart is a bit pixelized, but you went through the 1987 crash, you had here the dot-com crash, you had the great financial crisis, and you are still, even after those periods, after the financial crisis, after the dot-com crash, you'll still be better off by having your allocation into the 50% SPY and 50% TQQQ rather than just SPY. So, in fact, what you can say is that SPY plus TQQQ reduced your risk because in this way, well, you had larger drawdowns, but your larger drawdowns came from a higher high, okay? For example, at the top of the dot-com bubble, your SPY will be worth $10,000, while your SPY plus TQQQ will be worth $146,000. And then, of course, with the dot-com crash, you have a large drawdown, but because you come from such higher level when compared to SPY, your performance, even after the crash, is better, okay? For example, at this point, random point, SPY is $8,000, and SPY plus TQQQ is $19,000. Okay, but guys, very important question here. Why do you think this portfolio outperforms? And why do you think it's worth to do the rebalancing? The rebalancing is here very, very important because if you do rebalancing, you are taking profits automatically on the way up, right? This is the magic of rebalancing, okay? So during the dot-com bubble, there was no TQQQ, we are just doing a simulation, but if there was a TQQQ ETF, it will have gone up a lot, okay? And by rebalancing every quarter, in this simulation we are doing every quarter, you are taking profits from the TQQQ and trickling down to something more conservative, which is S&P 500 SPY. And that's the secret sauce. You can do rebalancing every quarter, or semi-annually, or even once a year. It doesn't matter. You need to check your taxes in the country where you live, because sometimes rebalancing annually might give you more advantages in terms of taxes than doing it quarterly. If that's the case, to be honest, the difference between quarterly rebalancing and annual rebalancing in the long term is not huge. So rebalancing is the secret sauce here, again, because as the market is climbing, if you rebalance, you are basically taking profits and trickling down to something a little bit more conservative, which is the biggest point in this strategy. So the outcome, again, will be very, very different for these two different strategies. The blue line is like microscopic when compared to SPY plus TQQQ. Now, I'm not saying that you should go all in into this strategy. I'm not saying that you should do only this strategy. But if you your portfolio can have different buckets. In my portfolio, I have different buckets. I have my individual stock portfolio, I have my ETF portfolio. In my ETF portfolio, your ETF portfolio bucket can be 10% of your entire money, or 20%, or whatever, depending on your risk profile, and depending on your goals, depending on your age, okay? If you are young, you can do more leverage. If you are older, do a bit less leverage. But this is the way you do it, and you can allocate according to your risk profile. It's very important to allocate according to your risk profile because you need to sleep well at night. It's not only about backtesting. The psychology of investing is also very important, and you need to follow a strategy that lets you sleep well at night. So if you cannot sleep well at night by allocating $50,000 to this strategy, allocate only $5,000, okay? That's a very important point. Now, in this simulation, we have only allocated $1,000. Remember, this went from $1,000 to $1.3 million. Okay, this is an absolutely crazy return. Crazy return. But what if you have added a little bit of DCA? This is what I'm going to simulate now. What if you have a DCA $100, only $100 per month? Okay, come on. Anyone can do $100 per month, right? So let's do $100 and click backtest. And let's see how would your retirement after 40 years of doing initial investment, $1,000 and then $100 every year. Wow, okay. So in terms of total contributions, you have done total contributions of $49,600, so close to $50,000. And in the SPY S&P 500 case, you'll have $866,000, 866,000, close to $1 million. In the SPY plus TQQQ, you'll have $10 million. 10 million. Wow, this is it's quite a nice bag for an investment that was as little as like $50,000, right? It has significant utility and can significantly improve your retirement. It's going from $800,000 in SPY to $10 million in SPY plus TQQQ. It's more than 10 times more of the SPY alternative. Again, most people that are into FIRE, financial independence, retire early, which I love, okay, I love that movement, okay. I love to practice frugality, I love to save money, I love to invest consistently, I love to live below my means. These are all values from the FIRE movement, from financial independence, retire early. But usually people on the FIRE movement are just like, oh, just invest S&P 500, that's it, only S&P 500. And you can give a significant boost to your portfolio by adding some leverage ETFs. Okay, now let's be honest. In this strategy that I share here in this video, we have 50% S&P, 50% TQQQ. But there are many other strategies, okay? You don't need to do 50-50. You could do 10% allocation to TQQQ. 10% allocation to TQQQ would already double your entire portfolio after this period. You can do 20%. You can do a bucket, again, you can do a bucket that, okay, I'm going to put $10,000, $5,000 aside for this strategy, and I will not touch it for the next 10 or 15 or 20 years, okay? You can do within your Roth IRA. Yeah, I have lots of members in my community that are leveraging their Roth and IRAs accounts to do this. Now, I'm not American, so I don't have access to that kind of stuff, but getting this thing done on a tax-free manner, it's very cool. You also don't need necessarily to use TQQ. You can go to something a little bit more conservative, such as QLD, which is 2x leverage, such as SSO, S&P 500 2x, or UPRO. And if you are asking if it is this is the first time you are watching my videos, and now you might be saying, oh, what about volatility decay? These ETFs can go to zero, blah, blah, blah. And let me just quickly answer those concerns. Volatility decay, it's a reality, but as long as volatility is less than the returns, it's okay. So there's something called the Kelly criterion and the Kelly criterion curve. So there is a certain level of leverage that you can use to maximize your returns without increasing volatility so much that will eat up your returns, okay? So there is a balance there, okay? But the balance is never 1x. People invest in SPY and invest with 1x leverage, not because it's optimal, it's just that it's conventional, okay? Everyone is investing with 1x leverage because it's just conventional. Why not 1.5 or 2 or 3, okay? Beyond 3x leverage, you start to have the so-called volatility decay because you will have so many swings that those swings will just like make your portfolio go down over time. But if you use 3 or less than 3x leverage, when it comes to broad indices, the volatility will not eat up your returns. Okay, so you can use for the long term 2 to 3x leverage ETFs. There are papers such as Alpha Generation Through Managed Volatility that shows that you could have used 2 or 3x leverage in the S&P 500 for the last like 70 years and you'll perform very, very well. So it's a myth that volatility decay will eat up your returns, unless the underlying, again, is too volatile. That's why I don't leverage most individual stocks. I don't leverage Bitcoin, because that indeed you have volatility decay for sure. Now, can these ETFs go to zero? No, they cannot go to zero. That's pretty much mathematically and impossible, and actually, according to the rules of the stock market, they cannot go to zero. Or for them to go to zero, the index will have to go to zero. For TQQQ to go to zero, Nasdaq 100 will have to go to zero. There are a couple of reasons for this. One is the daily rebalancing, okay? Daily rebalancing actually is very positive for leverage ETFs. Because imagine that TQQQ dropped by 10% one day. Extreme crash, right? Cut. Because imagine that QQQ or Nasdaq 100 dropped by 10% in one day. TQQQ will drop 30%. And then Nasdaq drops 10% more. TQQQ will drop 30% more. It's like, but it never goes to zero, okay? Imagine you have a stick. You cut this stick into half. Now you have the other half of the stick. You cut this stick, the other half into half. Now you have 1/4. You cut into half. Like, it never goes to zero, right? So stock markets kind of, and leverage ETFs work the same way. There is no way it can mathematically go to zero. So just to be mathematically accurate here. Also, very importantly, the stock market has circuit breakers. And the circuit breaker says that if the stock market drops more than, I don't have now the exact numbers, more than 5% or so, they halt the trading for the rest of the day. I don't know if it is 5 or 7 or 8, something like that, or 10, meaning that the stock market cannot drop more than X% in one single day. And for TQQQ to actually go to zero, the stock market will have to drop 34% in one single day, which doesn't happen. It never happened in history. And honestly, if that was to happen, it's better you have convert all your investments into canned foods and bullets and guns, because apocalypse is coming, right? And also, for these circuit breakers, one of the things that you count towards the circuit breaker is the previous the overnight, okay? So people sometimes say, oh, what if there is a overnight gap in the stock market? Well, that also counts towards the circuit breakers. So no, TQQQ cannot go to zero. Now, a Bitcoin leverage ETF, for example, can go to zero, or a Tesla leverage ETF can go to zero, okay? Individual stocks can have such large swing in one single day that the leverage ETFs can go to zero, but not S&P 500, not Nasdaq. For that to happen, I don't know, it will have to be like the end of the world. And if that happens, the leverage ETFs are your least concern. So guys, I hope this video was clear, and I hope I have addressed all your concerns. And this is a pretty cool way of like visualizing the potential of leverage ETFs, right? SPY, you could have like $1 million or $800,000. SPY plus TQQQ, you go to $10 million. That's a huge difference. That's one of the reasons why I like leverage ETFs as part of a diversified portfolio. Never go all in into leverage ETFs. Invest only a small percentage. I'm not going to say invest only what you can afford to lose. I think that's a very silly thing to say, because I have like 50% of my portfolio into leverage ETFs and I cannot afford to lose it. But I have a very diversified leverage ETF portfolio. I have QLD, I have equally weighted S&P 500, I have financials, I have healthcare, I have Berkshire Hathaway, I have bonds, I have leveraged bonds, I have cash. Okay, so I'm investing in leverage ETFs, and I'm not investing what I can afford to lose. I'm investing what I can sleep well, something that allows me to sleep well at night. Because it allows me to sleep well at night because I don't need this money immediately, and also because I have a strong investment thesis and strategies that I share in my community. Again, check the link in the description for my community, 7-day free trial. You can cancel anytime, but I want to see you there, and I want you to be part of the amazing discussions that we have there about leverage ETF strategies. All right, guys, if you enjoyed this video, give it a like and subscribe, and I'll see you soon. Bye.